What if the single most expensive mistake in your entire retirement plan costs absolutely nothing to fix, takes less than 10 minutes, and almost nobody actually does it? Not a bad investment. Not a fee you didn't notice. Not some complicated tax rule buried in legislation. A form. A completely free form that sits inside your super account right now, waiting to be filled out, and most Australians have never opened it, let alone completed it. Here's the assumption almost everyone quietly carries around. You've got a will, you've told your family what you want to happen to everything you own. So naturally, your super just follows the same plan, right? It goes wherever your will says it goes. That assumption is wrong for a huge number of Australians, and it's not a small technicality. It's the difference between your family receiving what you intended, quickly and without dispute, or your super ending up somewhere you never actually chose, while your family deals with delays, confusion, and in some cases a tax bill nobody saw coming. Today, on RetireScope AU, I'm going to show you exactly what this form is, why it quietly expires without you ever being told, and how getting this right protects the people you actually care about. This isn't really a video about maximizing your wealth. It's about making sure the people you love are actually looked after the way you intended. Before I get into it, if this is useful to you, hit like on this video, subscribe if you haven't already, and honestly send this one to a parent, a partner, or anyone who's super you genuinely want to end up in the right hands. This is one of those topics people don't think to talk about until it's too late. Let's start with the misconception, because I think this is where the whole problem begins. Your superannuation is legally held in what's called a trust structure. It is not automatically treated as part of your estate, and it doesn't automatically follow the instructions in your will, unless you've specifically set things up that way. Your house, your car, your savings account, those generally get distributed according to your will. Your super operates under a completely separate set of rules. So if you haven't told your super fund exactly who you want your death benefit to go to, using a valid legally binding nomination, here's what actually happens instead. The trustee of your super fund, not your family, not the person you'd have chosen, decides who receives it. They'll generally consider dependents, they'll look at your relationships, they'll try to make a reasonable decision. But a reasonable decision made by a trustee who never met you is not the same as the decision you would have made yourself. I've seen this play out in a very specific way. A parent remarries later in life. Their adult children from a first marriage assume everything will simply work out. Their new partner assumes the same thing. Nobody actually puts it in writing with the super fund itself. When that parent passes away, the trustee is left trying to weigh up two competing claims, using nothing but fund records and the legal definition of a dependent, with no idea what that parent actually wanted. That's not a rare, extreme scenario. That's a completely ordinary Australian family, and it happens more often than most people realize. And here's where this starts to get genuinely expensive, not just complicated. There's a specific document that solves this entire problem, and it costs nothing to complete. It's called a binding death benefit nomination. Every major super fund in Australia offers one, and in almost every case, there is no fee whatsoever to make, change, or cancel it. You log into your fund's online portal, or download a form, name exactly who you want your super to go to, and once it's correctly completed and witnessed, the fund is legally required to follow it. Not a suggestion, not something the trustee weighs up alongside other factors, a direct binding instruction. Some funds also offer what's called a non-binding nomination, which people sometimes mistake for the same thing. It isn't. A non-binding nomination is really just a guide. The trustee can consider it, but they're not required to follow it. If the only form you've ever filled out was non-binding, and you assume that settled the matter, it genuinely hasn't. But here's the twist that catches out even people who did the right thing years ago, because their nomination might have already quietly expired without them knowing. This is honestly the part of this topic that surprised me the most when I first properly looked into it. Most binding nominations are not permanent. Unless your fund specifically offers what's called a non-lapsing nomination, and you've actively chosen that option, your standard binding nomination generally expires after 3 years. Think about how that plays out in real life. Someone fills out the form in their 40s, feels genuinely relieved they've sorted it, and mentally files it away as done forever. 3 years pass. Life moves on. Nobody sends a dramatic warning. There's no flashing notification. The nomination simply lapses quietly in the background and reverts back to trustee discretion, exactly the situation you thought you'd already avoided. There's a real case that CBUS Super has actually documented that illustrates this perfectly. A member referred to as Chris had made a nomination years earlier. But when one of his originally nominated beneficiaries passed away before he did, he never went back and updated the form. When Chris himself later passed away, CBUS had to assess his death benefit as though no valid binding nomination existed at all, because the one he'd made no longer reflected a valid, current set of circumstances. If he'd simply updated that one form after his beneficiary passed, his daughters would have received his benefit far faster, and with far less uncertainty for the family during an already difficult time. And this connects to something ASIC has actually been raising concerns about through 2026. Regulators have specifically flagged delays, administrative issues, and inconsistent handling of death benefit claims across parts of the super industry, much of it tied back to exactly this problem, members not having a valid current binding nomination in place when it actually matters. So that's the delay and confusion side of this mistake. But there's a second cost hiding inside all of this, and it's the one that genuinely surprised me when I first saw the actual numbers. This is the tax side, and I think it deserves its own moment because most families genuinely don't know this exists until they're already dealing with it. Under Australian tax law, whether your super death benefit is taxed depends entirely on who receives it. If your beneficiary is what's called a tax dependent, generally your spouse or a child under 18, the payment is completely tax-free. But if your beneficiary is a non-dependent, which most commonly means a financially independent adult child, the taxable component of that payment gets taxed at 17%, made up of 15% plus a 2% Medicare levy. Let me put an actual number on that because it makes this real in a way percentages alone don't. Say the taxable component of your super death benefit comes to $300,000 and it's paid to your adult child. At 17%, that's roughly $51,000 going straight to the Australian Taxation Office. Your child receives around $249,000 after tax instead of the full $300,000. If that exact same amount had gone to a spouse or a dependent child, it would have been completely tax-free, no deduction at all. I want you to sit with that gap for a second. $51,000. Not because of a bad investment, not because of market conditions, but purely because of who ended up receiving the payment and how that nomination was structured. This isn't a minor technicality buried in fine print. It's a genuinely significant difference in what your family actually ends up with, and it's happening to families right now who had absolutely no idea this rule existed. So now let's bring this together, because there's something worth knowing. Every single part of this is fixable in one sitting, and once it's done properly for years. Here's exactly where to start. Log into your super account, or call your fund directly, and ask them plainly, do I have a binding death benefit nomination on file, and is it still currently valid? Many funds will tell you this immediately. Sometimes it's right there on your account dashboard. If you don't have one, or your fund confirms it's lapsed, completing the binding nomination form is genuinely a 15-minute process for most major funds done entirely online. Name your beneficiaries, specify the percentage each person should receive if there's more than one, and have it witnessed correctly, which most funds now make simple to arrange. While you're on the phone with them, ask one more question. Do you offer a non-lapsing option? If they do, and it suits your situation, choosing that removes the 3-year countdown entirely, so you're not relying on your future self to remember to renew it down the track. From there, treat it the same way you'd treat updating a will. Review it after any major life event. A marriage, a separation, the birth of a child, or the passing of someone you'd previously nominated, exactly like what happened in Chris's situation. And if adult children are involved, and that tax difference we just discussed genuinely applies to your situation, it's worth having a proper conversation with a financial advisor about estate planning strategies that can legitimately reduce that tax exposure. There are legitimate ways to structure this more effectively, but they need to be set up properly and in advance, not figured out after the fact. Here's what I want you to take away from this entire video. The most expensive mistakes in retirement planning aren't always about risky investments or market timing. Sometimes it's simply a form that was never filled out or one that quietly expired years ago without anyone noticing. It costs nothing to fix. It takes minutes, not months. And getting it right is one of the clearest, most direct ways to actually protect the people you care about most. That's exactly why RetireScope AU exists, to make sure Australians know about the things that genuinely matter, before they become a problem for the people left behind. I want to hear from you on this one. Drop a comment below and tell me honestly, did you know your super doesn't automatically follow your will? And have you actually checked whether your nomination is still valid right now? I'm genuinely curious how many people are learning this for the first time today. And if you know someone who's never thought about this, especially a parent, send them this video today. It's 10 minutes that could genuinely save their family thousands of dollars, and a lot of unnecessary stress down the track. Thanks for watching. I'll see you in the next one.